What's up everyone, it's Karthik with MoneyVest. So in today's video, we are going to be talking about the Magnificent 7. So we're going to be running a full technical analysis on these 7 companies. I'm going to be talking about Tom Lee's report for why he believes that the S&P 500 is on its way to increasing by over 200% or tripling by the year 2030 to over 15,000 points, and also unpack some of the more sort of disturbing charts that I think are really important for us to understand and know moving forward. So again, hope you all enjoyed this video. There's going to be a lot of information and a lot of data that we need to unpack and uncover in this video. Make sure that you drop a like and subscribe to the channel. I would really appreciate that. And again, links to our Discord and Patreon is going to be down below. We've got 3 more spots left with a 51% discount that's available until the end of this month. You can only take advantage of it while it's limited for a limited time. And of course, you can access the entire platform, do your full comprehensive fundamental analysis, including fundamental charting, looking at intrinsic values, calculating your own intrinsic values, looking at analyst estimates, forecasted EPS and revenue consensus from analysts here. And again, a lot of other features are going to be making its way onto the platform very soon. So there's going to be more features coming soon for you. So link's going to be down below with limited spots and a 51% discount available until the end of this month. So we'll love to have you on board. So first things first, I really want to go over the technical piece for the S&P 500 stocks, so such as Magnificent 7. And then we're going to circle back to a more longer term view that S&P 500 is going to more than triple according to Tom Lee. So some of the analysis points I'm going to break down. I'm going to share my thoughts and my views as well. Now, as you'll notice, the MoneyVest index is at a on 0.4, so 4 out of 5 is where we are. Again, the higher it is, the more unfavorable the markets are from a risk reward standpoint, and the lower it is, the more favorable the markets are from a risk reward standpoint. This also is eventually going to make its way over to the MoneyVest platform, which I think is going to be super useful for all of you to utilize, because this has a very high success rate when back tested over the last 25 to 30 years, because it's a combination of a lot of really important metrics that we look at from a technical analysis standpoint, from a volatility standpoint, from a market breadth standpoint. So this, again, when it signals buying opportunity for me, I deploy cash heavily into the market. And the last serious buying opportunity when I bought close to $15,000 to $20,000 worth of stocks was back on April 20th. Since then, the market's been ripping higher. Prior to that was back in October of 23. Prior to that was back in March of 23. And then, of course, the big bottom in September and October of 22, where the S&P 500 is now up over 60% from those levels, and NASDAQ is up well over 80% from those lows from back in 2022. So again, super important for us to keep a close eye on where this index is. And given how high it is right now at close to 4, just goes to show that the risk reward is not that favorable at the moment, and we're just kind of better off patiently waiting for markets to give us an opportunity. Right now, we're just kind of sitting back, taking advantage of the gains, selling calls, taking advantage of the momentum higher and higher. Although we did see Thursday to be a very brutal day for the markets, where there's a lot of targeted sell-off for big tech, and of course liquidity flying over to other parts of the market. But then Friday we saw a little bit of rebound once again. So very important index to watch. Close to 4 is where we are at. Volatility continues to be incredibly low at 12.45, trading at really low percentiles, and again in that rare category of where we like to see over the last 35 years worth of historical data. Again, it's very rare to see the volatility trade at close to 12, 11, 10. The lower it gets, the more cautious we need to be. It's just plain and simple. The higher the VIX is, the better the opportunity, the more obvious it becomes that we need to start buying stocks and deploy more cash into the market. So given how it is at really low levels at 12.45, again, just sitting back, taking advantage of the market's rally and the momentum, and not really doing much at the moment. So coming back over to individual stocks, and before we get there, I also want to go over some market breadth indexes. So talking about S&P 500 stocks that are trading above their 50-day moving average, we're at 68.58%, so meaning 32% of stocks are trading below their 50-day moving average, which again is a really low number, meaning that 2/3 of the S&P 500 is above its 50-day moving average. So again, goes to show that this market momentum, this rally is starting to kind of, over the last 3 days, especially, as you'll notice that we have gone from 41% to 68%, meaning that we have seen more participation, more broadening out of this rally over the last 3 days as money has moved out of technology, the concentrated sector, over to other parts of the market. And it's now approaching some of those higher levels, closer to 79 to 80% levels for this particular index. And keeping that in mind, again, it is very important for us to understand the higher it is, if it's inside this red zone, which is the red rectangle that I've marked out. If you come over to the weekly time frame, again, if it's inside the red zone, it becomes more and more cautious. We need to be more cautious. We need to be more aware that there is a possibility for a technical pullback or a dip or a correction, given how overbought the entire market is. Just something to keep in mind. Again, it is not a straight up buy or sell signal. It is not a straight up timing signal. It's just for us and for our understanding how overbought or oversold the entire market is on an aggregate perspective. And again, just how favorable or unfavorable the market opportunity is. So again, we're at 68%, so nothing to be too afraid of. But if we do get to higher levels at around 85% or higher, then again, we're going to be inside this red rectangle. And similarly, if you come over to the index, which is S&P 500 stocks trading above their 200 stable moving average, not the 50, but the 200, which is kind of like the mother of all moving averages, a longer dated moving average, you'll notice that we're at 72%. And this past week, we climbed 11% or 7 percentage points higher. And similar to what we just looked at, if it gets to inside this red rectangle, inside the 85 to 95 to 100%, closer to 100%, because we can't go more than 100%, right? So the closer we are to 100%, the more cautious we need to be. And these right here, the green rectangles, are the picture perfect buying opportunities for the market. And this is where patience comes into play, right? It's great to buy something on its way up because we're seeing a lot of momentum. We're seeing a lot of optimism around individual stocks and the entire market. So yes, it makes sense why you want to buy something on the way up because there's a lot of momentum, but that becomes more of a momentum trading as opposed to buying when there are actual discounts and deals. And these are some of the indexes or indicators to keep in mind to show us when there is actual weakness, when there is actual opportunity in the market. So when these indexes come down to these green rectangles, these levels where are marked green, that's where, in my opinion, the opportunity, the majority of the money is made. Because if you're able to deploy heavily when they're hitting down to these levels at 40%, 25%, or even in low double digits to somewhat single digit numbers, that's where majority of the market is extremely oversold, heavily discounted, valuations are cheap, markets are selling out of fear. There's a lot of fear and panic in the entire market, and that's when you jump on those opportunities and deploy cash heavily. That's when your money is going to buy majority of shares for individual stocks that are trading at cheaper and cheaper valuations and prices. So that's why it's really important that patience is key here. You're going to get opportunities. It's a fact. The markets are moving in cycles. Markets are going up and they're going down, right? We just have to wait patiently for those opportunities. And I have done that over and over and over again. We have done that as a community. We've done that over and over and over again. Just go through our Discord, come to our community. You will see that we are very patient investors that look for opportunities very, very closely based on true data-driven analysis that we're doing on the markets. Now, coming over to individual stocks. So I'll be very honest. A lot of companies right now that we're going to analyze among Magnificent 7, all of them are overbought. There's not a single company that I've found that wasn't overbought. You look at Apple, you look at Amazon, you look at Microsoft, Google, Nvidia, Tesla. They're all overbought at the moment. And that is exactly why the concentration is so high among these companies. If I come over to my spreadsheet, as you'll notice, the concentration for big three, which is just your Apple, Nvidia, and Microsoft, is over 20% as of this moment. Magnificent 7, which is what we're analyzing right now, is about a third of the S&P 500, so 33%. And top 10, which is including your Berkshire Hathaway and your Eli Lilly's, and of course another company, Broadcom. So these are the 10 companies that we're accounting for in our top 10 analysis. It's about 36-37%. So again, about 2% or less than 2% of the S&P 500 controls over a third of the S&P 500 in terms of its influence on the entire market. Something to keep in mind, which is again equally important, because the moment that these companies start selling off, as we witnessed on Thursday, it was a very targeted sell-off. Guess what happens? NASDAQ has a bloodbath. It was down almost 2%, S&P down almost 1%, and there was a lot of pain during that day when stocks were incredibly getting sold off, especially in the technology sector. So concentration risk is very, very high in the market. I think that's just a given. And this right here is going to be the technical analysis on Apple. As you'll notice that it's gone through periods of consolidation and then finally breaking out to new all-time highs. It's happened over and over and over again for Apple stock. And right now we're once again trading at an all-time high. You can see the RSI, you can see the MACD, very, very overbought at over 75 RSI. Very rarely do we see Apple at an RSI at over 75. The last time we witnessed that was back in July of 2023, so just about a year ago. And since, of course, Apple consolidated sideways, it even dropped over 15%, back down to lows of about 160s, and of course consolidated sideways before finally breaking out to new all-time highs of over $230. So if Apple were to pull back, which is likely, which is not something that's off the table, another 14 to 15% sell-off is on the table, something that I'm not predicting is going to happen, but something that could happen, something that we have to be aware is a possibility considering how overbought we are, once again, on the RSI and the MACD. And that's going to put us down to about sub 200, closer to 198. To be precise, that's going to be aligned with this previous resistance as a new support for Apple. So again, keep in mind that that is going to be the next level to watch given how overbought we are. Amazon, on the other hand, continues to struggle at $200, right? So $200 is a huge resistance for Amazon, and this right here is the entire chart where there's also a little bit of that negative divergence. So this right here is the sort of like the lower highs for Amazon, as you can see, the lower highs, and again the price itself continues to make higher highs. So there is some momentum on weaker and weaker breadth, and you can see the MACD as well just consolidating sideways. Not a lot of momentum here for, actually this is the L3 banker oscillator, so my bad. So it's just really been consolidating sideways. So we do have a bit of a rising wedge formation for Amazon. If it continues to trade inside this wedge, sooner or later it's going to really coil into that corner, and there is a potential for a bit of a breakdown because rising wedge patterns usually do see some breakdowns in the future. So support levels to keep in mind, 189. So that's going to be this first level aligned with this previous resistance as a double top where it got rejected a couple times, all the way down to as low as 170. So this right here is going to be that next level. So keep in mind, once again, a couple times it's validated as a support and previously as a resistance as well. And then all the way down to a much, much stronger area of support in the 145 to 150 inside this green rectangle, although I do believe it's quite unlikely that Amazon trades back down to 145 or 150s. But again, in the market, anything is possible. So keep in mind at 189 to 190 first, down to 170s, down to 145, 146 for Amazon. Before we move any further, I want to reiterate. So right now we've got a 51% discount. We'd love to have you on board, and we had over 300 plus signups in our community, and our team handled over 50 plus support tickets in the last week, taking in your feedback, taking in your suggestions, and fixing and deploying code to really fix some of those bugs. So we really need your help in trying to make this the best platform available out there. So again, if you want to get access to the entire platform here, link's going to be down below with about 3 to 4 spots left and a 51% discount that does expire at the end of this month. So link's going to be down below. Next one on the list is going to be Tesla. So as I already mentioned, that most companies are indeed overbought. So it's not unlikely to see a bit of a pullback. And this right here is going to be the full updated technical analysis on Tesla. A bit of a downtrend that it's still trading at. So this is going to be that lower high and this lower low pattern. This was overshooting to the downside significantly. And again, still trading inside this downtrend and pushing higher. And now we're approaching this resistance, a very, very important area of supply, once again at around $275 to $300. Tesla did get up to as much as 271. Was not able to stay at those levels. And of course, Thursday was a huge sell-off, and then Friday, a bit of a recovery. So had a bit of a doji candle on the week here, but huge resistance. And I cannot emphasize how big this area of supply is for Tesla. It needs to gobble up all the shares in the 270s in order to just break out beyond 270s and have a chance of hitting 300. If it doesn't break above 270, I feel like it's going to go through something very similar as last time. Again, every single time it's gotten up to these levels, it's had a pretty severe pullback eventually. So this right here was a drawdown of almost 40%. This right here, of course, was a much significant drawdown of 65%. And this right here originally was a 37% pullback. And then, of course, eventually became a 52% sell-off for Tesla. So it needs to break out above this area of supply that's marked by this red rectangle. As you can clearly see, they have gone rejected here not once, which is over here. This was back in February of 21. This right here was back in August of 22. And this right here was back in July of 23. This right here was back in December of 23. And between those two numbers, those dates, September of 23 again. And once again, for the 5th time, we're back here inside 270s, inside the red rectangle. So it's incredibly important for Tesla to break out above this level. But at the same time, you've got an RSI and a MACD that's approaching overbought levels. So it's possible that there's going to be some back and forth between the bulls and the bears going into next week, which is going to make it even more exciting for us to see where the volatility takes us and whether we see a breakout or not. Let me know in the comment section down below, what do you believe, what do you think, is Tesla going to break out beyond 270s here and gobble up all the supply that's sitting and waiting for us here, or if for the 5th time it's going to get rejected again and start selling off once again. So let me know in the comment section down below. Moving forward, we move over to Nvidia, which of course has been incredibly strong. And we don't really have a lot of technical analysis on Nvidia, but the bottom line is it's starting to consolidate a little bit sideways now, still in a very, very significant uptrend. And what I've noticed is that Nvidia also goes through periods of consolidation before finally breaking out. So if I come over to the daily chart for Nvidia, you'll notice this yellow box, which essentially signifies areas of consolidation for Nvidia before finally breaking out. So this was back in 2022. This right here back in 2023, this right here back in 2024, and this is what we're going through right now. And every single time it consolidates for about 2 to 3 months. So this happened between July all the way to actually January, so about 6 months. This right here was between June and December. So again, June and December. This happened between March all the way to May. So about a couple months here, 6 months over here. And this once again started in June. So it's possible that up until December, because last 2 out of 3 times, it's actually consolidated for 6 months between June and till the end of the year. So it's possible that Nvidia consolidates sideways in this range that I've marked out in yellow before getting that next breakout once again. And it's still within the context of this entire uptrend, as you can see, between higher highs and higher lows. Of course, time will tell what ends up happening with Nvidia, but a very strong support is going to be sitting right over here at around $118 as it continues to get bounced off of that level. And a resistance that I'm going to mark out is going to be sitting right over here at 140. That's pretty much the all-time high, and this is the area of consolidation for Nvidia at this moment. Now moving over to Google. And Google here also trading at near all-time highs. So very, very overbought. And Google's kind of interesting in that sense that as it continues to trade in a bit of an uptrend, it is now starting to show some signs of a bit of a pullback as the RSI is starting to come down. the L3 banker oscillator also suggesting for a little bit of a selling pressure as well. So support level is going to stay put all the way down here in the 150s. And I do think that Google, if there's any company that could potentially sell off, it is Google because of how overextended it is from both uptrending channels. The first one's going to be this right here. So it's completely overshot to the upside. And the second one is another uptrending channel, which is where it's coming up to its higher high. So it's possible that we do see a bit of a retreat from Google, maybe not down to 150s, but there's going to be some more support levels to keep in mind. There's another one over here sitting for Google in the 170s. So that's another support that it kind of bounced off of after gapping up on earnings. So those are some levels to keep in mind. But again, overbought, risk of pulling back, support levels are going to be important ones to watch. And that's going to potentially put more pressure to the downside for the entire market. Now coming over to Microsoft and Meta. So Microsoft here also pushing higher, trading on a very nice uptrend, but it's got a bit of a negative divergence, as you can see. If you come over to, let's say, the weekly chart, you'll notice a very nice uptrend for Microsoft, consistent higher highs and higher lows. But at the same time, we've got a decent support sitting roughly at around $403, and this is the negative divergence for Microsoft as well. So Amazon with a negative divergence, Microsoft with a negative divergence, and then of course a lot of other companies trading at near overbought, overextended levels. So you just got to be extremely careful. And this is a cycle that's repeated itself over and over again. So this should never come as a surprise or new information. Of course, if you are a beginner investor or a trader, or if you're watching our channel for the first time, it can come across as something that's new and something that you've never, let's say, seen or heard of. But for experienced traders and investors, I mean, this is just a cycle that goes over and over again. It kind of repeats itself every few quarters, where we get to overbought levels, we see a bit of a pullback and a correction, investors buy back in, and then we go from oversold to overbought levels again, and then kind of cycle repeats itself. So for Microsoft, negative divergence to keep in mind, support level down as low as $400, down to as low as $340 a share, all the way down to as low as $218 for Microsoft as well. And last but not least, we got Meta Platforms, and Meta here Also trading at near all-time highs, a lot of consolidation, massive recovery from low 80s all the way up to over $540, and a lot of consolidation sideways in that range for Meta, with the resistance sitting roughly at 540 down to as low as $420 per share for Meta. So a lot of consolidation sideways, and that's exactly where it is trading at the moment. So a bit of a range-bound pattern for Meta that's going to be sitting right inside this yellow rectangle. So keep a close eye at that resistance at 540, support at 420, and it continues to trade in that range. So hope you all enjoyed this video and a complete update on Magnificent 7. I'm going to be doing the Tom Lee analysis and a few other charts in a separate, more macro video. I think that's going to be dedicated more towards the macro analysis. So hope you all enjoyed this video, full technical analysis on Magnificent 7. Again, make sure that you drop a like, subscribe to the channel. 51% discount on our MoneyVest platform, which you can access the beta right now and lock this pricing in for life. And this discount does expire at the end of this month. And of course, do your full fundamental analysis on individual stocks. Use our calculators to calculate intrinsic value on individual companies as well. Use the MoneyVest metrics, the fundamental analysis, do 10 years worth of analysis, plot a lot of things on the chart, visualize a lot of the data. You can also look at annual versus quarterly data, whatever you want, 12 quarters, and then come over here, analyze the data here, and also look at analyst estimates, future forecasted revenue and EPS. Use our calculators to figure out the future price target, and of course the intrinsic value for individual stocks as well. So links going to be down below, and we're going to be adding a lot more features over time for you to access as well. So as always, happy investing, and I'll see you all in the next video.